Hi, and welcome back. Let's talk about how an entity can address accounting mismatches by designating financial assets or liabilities as fair value through profit and loss, FVTPL. Let's start with own use commodity contracts. These contracts, which deal with non-financial items like raw materials, are often excluded from the scope of Ind AS 109. But what if the entity uses a derivative contract to hedge the price risk of this commodity? Here's the problem. The derivative is fair valued and its fluctuations are recorded in the profit and loss account. Meanwhile, the value of the own use contract isn't accounted for under Ind AS 109. This creates a mismatch in the financial statements. To resolve this, the entity can designate the own use commodity contract as FVTPL. Now, both the contract and the derivative are measured at fair value, eliminating the inconsistency and providing clearer information. Now let's talk about insurance contracts. Imagine an entity has liabilities under insurance contracts that are measured using current information. At the same time, the entity holds financial assets that would typically be measured at amortized cost, or FVOCI. The mismatch arises because the liabilities reflect current value changes, but the related assets don't. By designating these financial assets as FVTPL, the entity ensures that both the assets and liabilities are measured on a similar basis. This alignment improves the relevance and consistency of the financial statements. Next, consider an economic hedge that doesn't meet the hedge effectiveness test. Let's say the entity is managing interest rate risk with a combination of financial assets and liabilities. Some of these instruments, like derivatives, are measured at FVTPL, but others aren't. When the hedge doesn't meet effectiveness requirements, the fair value changes of these instruments may not offset each other properly in the profit and loss account. To address this, the entity can designate all related assets and liabilities as FVTPL, ensuring a consistent approach to their measurement. Finally, there are situations where an entity doesn't follow hedge accounting. Even if financial assets and liabilities share the same risk, like interest rate risk, they might not qualify as hedging instruments because they aren't measured at FVTPL. Without hedge accounting, the gains and losses from these instruments are recognized inconsistently. To resolve this, the entity can measure both the assets and liabilities at FVTPL. This eliminates inconsistencies and ensures that fair value changes are reflected cohesively in the profit and loss account. By using the FVTPL designation strategically, entities can reduce or eliminate accounting mismatches, providing more accurate and relevant financial reporting. Thanks for joining the discussion. See you next time.